All right, so this is the final lecture to prepare for NOCTI exam that we're going to take next week. Just to recap what we talked about so far, we covered accounting principles and ethics. We primarily focused on confidentiality, integrity, and conflicts of interest. Confidentiality means keep private information private. Conflict of interest means we avoid situations that are or could appear to be a conflict between our personal interest and our business duties. Integrity means doing the right thing even when no one is watching and even if it comes at a personal cost to us. If we know we are entering into something that could appear to be a conflict of interest, a person of integrity removes themselves from that situation to maintain accounting ethics. Those ethics are a higher standard for the industry than simply following an employee handbook or company policy. Then we talked about accounting processes. We discussed the accounting cycle and the 8 steps. Remember, some textbooks may include more or fewer steps, but overall the process is the same. We mainly focused on the sole proprietorship accounting cycle, but the same concepts apply to corporations as well. We discussed financial statements, income statement, balance sheet, statement of stockholders' equity or retained earnings, statement of cash flows. Remember, the statement of cash flows has 3 main sections, and it is the only financial statement that uses the cash basis of accounting. Most accounting follows the accrual basis of accounting under GAAP, which stands for Generally Accepted Accounting Principles. We also focused on closing journal entries. Remember the acronym READ? Remember, Reed was our expert on closing journal entries. So we close revenue, close expenses, close income summary, and close dividends. That helps us remember the order of the closing entries. Today's focus is financial ratios, payroll, and then we'll end with some accounting principles. Financial accounting primarily provides information for external users to evaluate the health of a company. Managerial accounting, which you would study more in accounting 2, is used by internal users to help managers make decisions. All right, so financial accounting, what we did primarily in accounting 1 is prepared for external users, so people outside the business. Managerial accounting focused more on information that's provided for internal users, like managers that are trying to make decisions on what to do going forward for the business to continue to be successful. All right, so before outside users see the financial statements, businesses often analyze their own financial health using ratio analysis. The key categories of ratio analysis are profitability, liquidity, solvency, and market performance. All right, so profitability, liquidity, solvency, and market performance. So profitability measures how well a company earns profits. One important profitability ratio is the gross profit margin. It's also often called the gross margin. All right, so the gross profit margin equals your gross profit divided by your net sales. All right, so how do you get gross profit? What is gross profit? Gross profit equals your net sales minus your cost of goods sold, or we've also called it the cost of merchandise sold. This ratio tells us how well the company sells products above their cost. So if a product cost us 50 cents, how much are we making off that 50 cents of cost? So this ratio gives us the margin just for what we're selling, all right? It does not account for operating expenses like salaries, utilities, or rent. It only measures the margin between the cost of the product and the selling price. Another profitability ratio is the operating margin. All right, and the operating margin equals your operating income divided by your net sales. So notice for both of these profitability margins that we've talked about so far, net sales is your denominator. So how do you get operating income? Your operating income is your gross profit minus your operating expenses. All right, so this ratio includes operating expenses and gives a more complete picture of profitability. So it's helpful if you remember the flow of the income statement when you're thinking about profitability ratios. So if you remember the flow of the income statement, you start with sales. After you have sales, you subtract your sales returns and discounts to get your net sales, right? So you take your sales minus its contra accounts to get your net sales. Once you have your net sales, you subtract your cost of goods sold to get your gross profit, right? So you have your net sales, which is your sales minus the contra accounts, discounts, and returns and allowances, minus your cost of goods sold, gives you your gross profit. And then once you have your gross profit and you subtract out all your operating expenses, you get down to your operating income. And this is before taxes. And once you have your operating income, you can subtract your taxes to arrive at your net income after taxes. So they might refer to operating income as net income before taxes as well, but your operating income minus your tax expense is going to be your net income. All right, so the next thing that I want to talk about is benchmarking, all right? Benchmarking. And so a lot of the analysis that managers do has to do with benchmarking. So what is benchmarking? Kind of want to. All right, so to evaluate ratios, businesses compare them to benchmarks. Benchmarking means comparing ratios against industry standards. All right, so you have certain goals and you compare yourself against industry standards. So, what are your competitors doing? What are their norms? What are their gross margins, right? You don't want your gross margins to be way higher than theirs. You don't want your gross margins to be way lower than theirs. You want to kind of be in line with your industry standards. Also, historical company data, right? So, what has your company done in the past, right? What has your company done in the past? And that could be the benchmark that you're comparing yourself to, that you're comparing your ratios to. Another thing you might compare yourself is your forecasted or projected performance. And this is primarily for companies that are brand new, right? They are just entering the business. They're young companies. Maybe they don't have a lot of competitors to compare themselves to. And so they just have to go off of what they thought they were going to do profitability wise. All right. And so if your company's gross margin is 40%, but the industry's average is 50%, that might give you an indication that maybe one, your prices are too low, or your costs are too high. Businesses have to investigate and take corrective action instead of waiting for problems to fix themselves. So the answer is never wait and see. The answer is what's going on, what changes do we need to make so that we're more in line with what the rest of the industry is doing. It could be a situation where we're purposefully pricing low so that we can gain some market share as the lowest cost provider, but also from a marketing perspective, that might hurt us and people might think that we have an inferior product, right? So we got to be really careful about how we play our games with margins, especially when there's a lot of competitors that we should be able to fall in line with pretty closely, unless that we are differentiating ourselves and it's very, very understood by consumers how we're differentiating ourselves. So to improve gross margins, there's really only two things that you could do primarily. One is to reduce your cost by finding vendors that'll sell you those goods at a lower cost. Or two, raise the prices that you're charging to your customers. All right. All right. So that's benchmarking. Now, trend analysis. All right. So the next thing I want to talk about is trend analysis. So trend analysis is simply looking or comparing yourself year over year, right? Trend analysis uses data over several time periods to help businesses plan for the future. For example, if sales increase every spring, a business may order more inventory during the spring. If sales decrease during the winter, businesses may reduce inventory and staffing during that season. So, trend analysis helps companies make better decisions about inventory, staffing, pricing, and planning. All right, so just consider, for example, a nursery, right? A plant nursery. They sell plants. Typically, their busiest season is going to be planting season. When is that? Usually the spring. Sometimes people plant things in the fall, so they take root during the dormant season, and then they come out blossoming or blooming or producing fruit in the spring. But either way, there's certain periods of time where that Callaway's, for example, may not be as busy. And if they're using trend analysis, they can forecast, all right, hey, we need a little bit more inventory during this season. We need a little less inventory during this season. We need a little bit more staff and temp help during this season. So we hire some more high school students or some college students during this time period. And then we don't need as many people in the middle of winter because nobody's buying anything to plant in the middle of winter, right? And so trend analysis helps us make those decisions. All right, the next thing I want to talk about is market ratios. And so market ratios primarily, they have to do with companies. All right, so we're talking about corporations here. And one of those important market ratios is earnings per share, or EPS. All right. All right. So we have market ratios and we have EPS. Now, EPS stands for earnings per share. And earnings per share equals your net income divided by the number of shares outstanding. Now, because the denominator here is the number of shares outstanding, this is a ratio that you cannot compare apples to apples. So you can't just go and look at Walmart's EPS and then directly compare it to Target's EPS. It won't be an apples to apples comparison. You have to do some manipulation before you can look at EPS because your denominator obviously is going to be different between those two. So it's not something that you can compare from one company to another. Net income comes from the income statement, and shares outstanding are usually found on the statement of stockholders' equity. So where does this information come from, right? The net income is going to come from your income statement. The number of shares outstanding is going to come from your statement of stockholders' equity. Another market ratio is the dividend yield. All right, so you got dividend yield. All right, so